What's up, guys? It's Zeb. A few hours ago, the Federal Reserve only an increase in their benchmark interest rate by another 75 basis points. That means today we are now sitting on it, the highest interest rate we've ever seen since 2008. This also marks the end, the era of free money that had begun 40 years ago, where every rate increases was not able to cross the previous height before, but now we are totally done. Buck this trend and mini printer
officially discontinued. That's why it is incredibly important to cover perfectly what they say is going to happen, the biggest during the next year. Change is being made. That means you, and most importantly, how you can
use this information to make you money. Although before we start from that, the Federal Reserve has just raised its rate. It means a lot to me if you picked up
like button and subscribe. The YouTube algorithm helps with this. Chanel pretty much does it all. Last-minute reporting is absolutely worth it. Here is a picture as a thank you, by Jerome Powell. All of it starts with the word investors hate. Inflation at a truly core level is only the rate at which the product and increase in price of services over time, reducing the value of your money today, and recently inflation has increased drivers for each rate increase that we are viewers because of it.
When the Federal Reserve raises rates, they do this by looking at the prices month after month, both increase and year after year, and then adjusting. These policies have to be brought in this way. Those prices bounce back in the short term. This means less pain in the markets, according to customer demand, and accordingly, analysts say the unemployment rate is high, while less jobs are created. But this most recent inflationary terms, along with the report, its implications are also mentioned. The rate hikes we've just seen. Here's the latest you need to know. The inflation report was released on Tuesday, September 13th, and for all surprisingly, it was a total disaster. This is because inflation was rampant. It is expected to go down after all, already down from 9.1 to 1.5%, and gas prices were. It was expected to fall. We should see inflation drop to 8, not a percentage, but instead it was a number. 8.3% year-on-year. With 1 month it rose 0.1% during the month. This means that inflation is not coming down as soon as the costs are expected. Continued growth throughout, with certain sectors and even energy prices have fallen in other categories. Americans will cost more. There is even less money left. This latest report is just the last. Monthly food and medical care increased. The 0.8% shelter increased by another 0.7%. And new vehicle sales are still cost more than the first month on top. This excludes core inflation. Food and energy prices increased by 0.6%. It is indicated by month per month. It is not just a random anomaly, and prices are rising from the federal level. In terms of now control of the Reserve, Federal Reserve rate hikes, he made it clear that he intended continue to increase your rate to fight as long as the work is not done, and until then inflation. That's all you can ask. Very well. What to do with what they call their 2% target, though? You and me, used car prices can go up to 40%. Record high oil prices and $2,000 median rent. Federal. The effects of the Reserve are to be balanced, maintaining maximum employment and value. After all, stability if they are low. If interest rates are high, prices rise too fast, but if they increase interest, the rate is much higher than unemployment.
There is a penalty due to this, a balance between ensuring economy
growing and ensuring business people are doing well enough to keep up payroll, which results in 2% inflation. Targeting is that the US, Canada, Japan, Sweden, and European central banks have all agreed to this. Even more remarkable is that the policy was the result of only one offhand remarks from New Zealand, who said that they wanted to target the 1%. And then they went up to 2%, giving a margin of error in voicing. A 2% inflation target was created. This leads to inflation expectations. It will not be so low that people hoard on their cash, but that won't happen either. So much so that people have savings completely wiped out, and that's it. The purpose of the Federal Reserve is to the goal here is that they will continue.
An increase in interest rates softens demand, rising borrowing costs, business agreement, and then finally inflation will return to normal. Targeting comes the hard part, though. where even if the Federal Reserve stops,
soon they can't make a sustainable one effect, but if they go too far, they can. Sending the entire economy into a recession or worse now a depression. Other investors such as Peter Schiff believe 2% is the target. It will not be achieved now. Inflation is here to stay and will get
much worse despite rate hikes due to over a decade of inflationary finance and fiscal policy. But in terms of what is happening now, Reserve just said, and how is it going to influence your investments with savings, real estate and stocks? Are you, although we need to know before we go in that while we're on the subject, rate of growth in economy and its effects, you may have noticed your investment cryptocurrency is taking one of them biggest successes, with Bitcoin recently dropped below $20,000 in fear of higher rates. However, if you want to take advantage of these low prices, Federal Reserve,
all is well then. In terms of what the Federal Reserve said just a few hours ago, they delivered a sharp blow rather than a repeating markets a negative forecast in the future and confirmed that they intend to expand prices are higher than expected the rest throughout 2022. How much more? You may well ask. They said we are probably going to see another 75 a base point rate hike in their next rate, another appointment in November, 50 basis point rate hike in December, putting us at some of the highest rates which we have already seen from the great. Besides the recession, that too made it clear that they expect 2022 to see after GDP growth at only 0.2% and revised each other projections point downward.
Our economy is going to slow down, possibly more than expected. Bring us economically recession, of course they call it down. A growth rate of 0 to 2%, that sounds too soft. Basically they are setting up hope our economy has potential, and there's no going back to recovery anytime soon. That our economy is slowing down. Because of this they think.
He mentioned that a soft landing would be challenging and eventually it will happen. Depends on how long prices stay high. After all, they understand this inflation, largely driven by supply shocks, Russia-Ukraine war, and a whole group
other factors that they absolutely have. There is no control over them now. The problems are going to get worse. Powell also said for our economy that it is necessary that they increase the rates now that earnings are still strong, unemployment is still low, and that the economy can absorb it. Then wait. The economy will overheat and then it will be done.
Be much more difficult to get back. In addition, they also mentioned the unemployment rate. They are likely to increase. Efforts are underway to restore price stability. Next from 3.8% to 4.4%. Year, and for all intents and purposes we're probably going to see fewer jobs opens up until things start to turn upside down. In 2025 the goal is that they want to no more to meet market demand for jobs, thus, wages will not be required. Increased than expected driving prices also ahead, but he said that the housing market is likely to go by way of correction during price resets onto a new normal after advanced mortgage rates. Housing, in their words, the market is not balanced and rate the increase should help normalize economy so that houses are not getting 10. Ask about the buyer first. It comes along as it hits. Now market by how much of one. We can see the improvement with appreciation. This is a reduction of more than 10 to 20% off peak price. If that is right, we can see house prices return to the level they came back from in 2021 overall, though the meeting was rather bearish with a lot of clear message that rates are moving. Plus they stay high for a long time. And unemployment is probably going away. This is a very different edition, more message than their previous meetings where he said that he is determined fighting inflation while providing sustenance. This is not the picture of the future this time. Above it is another aspects that everyone needs to make as aware of, and the fact that a few days ago the Federal Reserve stopped shopping for mortgage support securities that are widely held. Low mortgage rates make it easy. As you can see, banks will issue more loans. They have so much motivation. Be consistent from the beginning of the year, but now that they have eliminated their mortgage purchases, it is fully understood that the mortgage prices will become more expensive, and that will put downward pressure on the house
Prices now adjusted for inflation. The good news is that gas prices are continued decline in national wages skyrocketing or not leading to wages. There are cost spirals and supply chains started to get back to normal, but it's obvious that the Fed will continue to hike. Also rates to deal with inflation. The central bank says it is on record. I can assure you that my colleagues and I am committed to it. Project and we will continue it until then.
The job is done, so now in my opinion you have a really good time to be sure. An emergency fund is sitting on. Take advantage of the edge in cash. High-yield savings accounts finally started paying you a respectable amount of interest, and since then nobody knows what's going on. Keep investing continuously, although it seems the market will. The truth is none. Continue down, know exactly how long it will last or where exactly is going. That's why I stick to my routine. Continue to schedule dollar cost averaging markets on a regular basis and always love to break no matter what. Buttons for the YouTube algorithm that the people of the city. Thank you very much for watching.